Okay. Well, welcome everyone to this AEI conference on should Fannie Mae and Freddie Mac be shrinking or expanding their activities. Also sponsored by R Street Institute and Alex Pollock. So welcome on behalf of both R Street and AEI. This topic is very timely. There's a lot of things going on at the agencies that relate to their powers under the charter and various activities that they're undertaking. And so this, we think, is a very timely conference, which helps explain the turnout that we have for this conference. Also want to welcome all of those that are participating and listening via live streaming. We will begin by introducing the moderator, Alex Pollock, who will then start the program. Thank you, Alex.
Thank you, Ed. Ladies and gentlemen, good to have you all here, and I'm sure we're going to have a lively discussion. The title I originally proposed, by the way, for this conference was, Should Entities in Conservatorship with Zero Capital Be Expanding? This title was, however, rejected. It's been apparent for a long time that no private institution can compete with Fannie and Freddie, who get a government guarantee for free. A fascinating internal memo of Fannie Mae's from 1983, which I got from Ed Pinto, argued that at $97 billion in loans and MBS, Fannie was already too big to fail and the government had to support it. This was already accurate. Fannie wrote of itself then, quote, "No administration and no Congress could stand idly by and watch Fannie Mae collapse, threatening to bring down with it the entire financial system. The government, regardless of the party in power or the ideological predisposition of key officials, would have no choice but to step in and prevent a default." As events have proved, that was absolutely right then and now. Fannie's size now is $3.2 trillion, or 32 times bigger than it was when they wrote that, I thought, excellently reasoned memo in 1983. In inflation-adjusted terms, that's 13 times bigger. Moreover, while Fannie and Freddie used to be government-sponsored enterprises, now they're government-owned enterprises with an even closer relationship to the government. One result of this is trumpeted in a Freddie Mac press release of January of this year, which reads, 2017 multifamily volume tops $73 billion, setting new company record. Freddie Mac announced today it has retained its designation as the nation's top multifamily financier for the third consecutive year. Well, if you're a private multifamily lender, how do you compete with competition like this? Competition that has a free government guarantee. If we look around internationally, we find that many countries have grappled with what to do about competition from state-owned enterprises like Fannie and Freddie. One answer to this problem is a theory of what is called, quote, competitive neutrality as an international term. Competitive neutrality means that a state-owned or sponsored enterprises should not have any special competitive advantages by virtue of their government connection. Therefore, they are, when this doctrine is applied, assessed special fees, for example, to offset the advantages of their government guarantees and other privileges. I think it would be an excellent idea to apply the international principle of competitive neutrality to Fannie and Freddie. You'll hear a lot more ideas and perspectives today from our excellent and extremely knowledgeable panel, and let me introduce them in the order in which they will speak. First will be Ed Pinto, whom you've already heard from. Ed is the co-director of AEI's Center on Housing Markets and Finance. He and Steve Oliner have created the AEI Mortgage Risk, Collateral Risk, and Capital Adequacy Indices, and the Wealth Building Home Loan. Ed has been active in housing finance for 42 years, during which time, among other things, he was Chief Credit Officer of Fannie Mae. He's been an AEI Fellow since 2010, and I have to say nobody knows more about housing finance. Second will be Tom Lamalfa, who spent 4 decades analyzing housing finance as a researcher and consultant, and whose firm, TSL Consulting, specializes in survey research. Tom has studied the revenue and expense structures of the various mortgage production channels, mortgage brokers, government-sponsored enterprises, and financial forecasting for mortgages. In particular, Tom has been prescient concerning the past and the ongoing adventures of Fannie and Freddie. Next will be Mike Frantantoni, who is the Chief Economist and Senior Vice President of Research and Industry Technology at the Mortgage Bankers Association, where he oversees industry surveys, benchmarking studies, forecasts, technology, and policy development research. Before joining the Mortgage Bankers, Mike was a senior economist in the mortgage industry and served as adjunct professor at the University of Washington, Johns Hopkins, George Washington University, and Georgetown. Then will be Norbert Michel, who is director of the Center for Data Analysis at the Heritage Foundation's Rowe Institute for Economic Policy Studies. Norbert focuses on financial markets, regulation, monetary policy, and the long overdue reform of Fannie Mae and Freddie Mac. He was previously a professor at the Nicholls State University College of Business Administration, frequently testifies to Congress, and enlivens panels like this one. Next will be Mike Stegman. Mike is a senior fellow at the Milken Institute Center for Financial Markets, a fellow of the Bipartisan Policy Center, focusing on housing finance reform and affordable housing. He previously served as a senior policy advisor for housing to the National Economic Council in a previous administration, I believe, counselor to the Secretary of the Treasury for Housing Finance, and as Assistant Secretary for Policy of the Department of Housing and Urban Development, and he's written extensively on housing and related issues and worked extensively on the issues we're addressing today. Finally, we're pleased to have Ed DeMarco with us. Ed is president of the Housing Policy Council. He was previously a senior fellow at the Milken Institute Center for Financial Markets, and as we all know, from 2009 to 2014, he served as acting director of the Federal Housing Finance Agency, where he was the conservator for Fannie Mae and Freddie Mac. In this role, he was effectively the chief executive of the $5 trillion business of Fannie and Freddie. He has also been assistant deputy commissioner at the Social Security Administration. And Ed, looks like we especially need you whenever we have some massive government insolvency to address. Each panelist is going to talk for 12 minutes. Then we're going to give the panel a chance to react to each other, then open the floor to your questions, and we will adjourn promptly at 4 o'clock. Ed, it's great working with you to organize this conference, and you have the floor.
Thank you, Alex. So let me first start by saying this blob poster, which you all have silver copies of, is my creation. It is no reflection of opinions of the rest of the panel, but it's
artistic talents.
Or artistic talents. But we did arrange to have the blob on Turner Classic Movies last Thursday, in case you missed it, and it was really exciting. So the actually works. We've got two different. This is the first time this has been done where we have something different on each screen. So we have the blob on my right, which are excerpts from Ann Canfield's GSE report of the 1998-2000 period. And these are just a few, and I'll go through a few more, of literally thousands of quotes that I could have come up with. And then over here, we have the quotes from the last year or so. Any similarities between those quotes are not coincidental. So with that, we will go into the presentation. I look at this as the blob and the return of the blob, because what happened in the late 90s was an incredible expansion of the powers and the activities and the businesses of Fannie and Freddie. and that eventually was reined in some, although, of course, they ended up crashing and burning into conservatorship later on in 2008. But now we have what I call the return of the blob, where they're doing many of the same things. And so while they're still in conservatorship, but apparently with the blessing of the Federal Housing Finance Agency, they're once again expanding into new products and programs with abandon. And the process potentially will affect adversely many industries, businesses, and careers. We just don't know where this will go. And it is reminiscent of the movie of the same name, The Blob. So let's take a trip down memory lane as we revisit The Blob from the early late 1990s. The first is, what does the GSE charter mean? Well, it means what ever Fannie or Freddie says it means, and the regulator for that matter. Outgoing Fannie CEO in 1998 said, we interpret the charter vision as just do it, to do whatever it takes to get the job done for the benefit of consumers, of lenders, and the nation as a whole. So forget what the charter says. It's an expansionary document that can mean whatever it means to be. Not to be outdone, Leland Brenzel said, Freddie will continue to push the envelope, and under Freddie's charter, practically anything that increases the availability of credit and reduces cost is acceptable. And then we have, I thought the U.S. was a free economy until I learned about the GSEs. Fannie and Freddie have only one advantage over hedge funds, and that has never been tested, although we now find it was tested. But everyone assumes that the federal government and taxpayer money is standing behind the two agencies. GSE insurance gets better pricing at the expense of private insurers because of this implicit backing, and as Alex said, at no cost. The implied guarantee and low borrowing rates allow them these advantages in purchasing commercial mortgages for apartment buildings. Again, this is in 1998, and Alex is quoting what's happening in 2017 and 2018. GSE privileges can act as a barrier to entry by competitors and can result in a GSE monopoly. USA Today reporter notes that U.S. officials piously lecture around the world about economic problems caused by crony capitalism, yet what about Fannie Mae and other cozy arrangements right under their noses? Then, of course, there's the thing that justifies all this, making housing more affordable. Fannie Mae also reported that barriers to home ownership, such as not enough money for down payment to discrimination, have collapsed to the lowest levels since Fannie Mae began doing its survey in 1992. Again, this is in 1998. We had a very long road that we went on. This is just about a third of the way down the road, but this is how it was being trumpeted in 1998. Fannie and Freddie's entrance into the subprime market might tighten subprime margins. We think it's completely consistent to enter and serve these markets. Freddie Mac. Fannie announces their success with low down payment programs. While they announce their success, consumer groups worry about increased risk of default from these low down payment loans. Again, that ended up 10 years later coming back with a vengeance. Automated underwriting. This is one of the little-known pieces of the control and monopolization that Fannie and Freddie exercise over the market. Back in the early 90s, lending institutions, insurers were spending hundreds of millions of dollars on automated underwriting and risk systems and things like that. But Fannie and Freddie were able to spend billions of dollars. And as a result, they not only crowded out the rest of the private sector, but Fannie ultimately crowded out Freddie Mac. Freddie Mac by 2004, 2005, 2006, 80% of the loans it was purchasing were going through the Fannie underwriting. Why? Because the Fannie underwriting had a lower credit standard than the Freddie underwriting for an accept. And so lenders knew that, and so Freddie eventually had to accept the Fannie underwriting. Think about that type of thing. If Freddie can't even compete, then how is the rest of the market supposed to compete? So the financial incentives Fannie and Freddie provide to lenders to use their automated underwriting creates this duopoly, which eventually turned into a monopoly. Fannie technology dominates the mortgage industry. The quality of the input that determines the underwriting conclusion is hard to monitor and can lead to poor overall risk management. Again, 20 years ago, these were being talked about as concerns. Morgan Stanley reported that Fannie's technology is ubiquitous throughout the origination community. And about this time, and we'll see why this is important because of what's going on today, in about 1998, don't remember the exact date, one of the GSEs went to the private mortgage insurers and said, oh, good news. We've now arranged for our automated underwriting to give an approval, including your mortgage insurance approval. And then the response was, wait a minute, how did you do that? We have our own separate underwriting requirements. Oh, we forgot to tell you that you have to give us your pen in order for us to do that. And by the way, one of your competitors has already agreed to this, and this was a commodity business, so the bottom line was the others fell rapidly in line. However, just this week, in what can only be called the other shoe dropping, Fannie Mae does what Freddie Mac did a few months ago with their Imagine program, and they announced the enterprise paid mortgage insurance option. And in their material, their FAQs, they say, quote, loan quality and eligibility are determined by Fannie Mae, not a combination of Fannie Mae and MI guidelines. Again, deja vu all over again. The problem is, and this is also considered a feature, but it's really the problem, a number of the MI companies beyond Arch, which was the original company, some of the other companies are now rumored to be participating in the Fannie Mae program, in my opinion, because this is an existential threat to mortgage insurance. Just like they had to give up the pen in 1998 or so, they're being forced to do it again today. So again, 20 years later, we're seeing the same things. The problems of these types of issues are that they lead to the excesses that we experienced back in the late 90s and the aught years, and now they will lead to the same excesses. It almost doesn't make any difference what the issues are. They will be taken to their excess because that's the way the GSEs operate. And so that's a fundamental problem, although, as we see, the things that they're doing are, in many cases, precisely the same things. Multifamily lending, trying to take over the mortgage insurance industry. Countrywide CEO Angelo Mazzillo in July of 1998 says, I don't believe that the mortgage market should fear Fannie and Freddie. The GSEs are your friend, not your enemy. In one of the shortest cases of whiplash on record, 4 or 5 months later, he's unnerved by what he sees as attempts by the GSEs to delve into customer base and ancillary businesses of mortgage bankers. It's a frightening concept. And a few months later, Fannie Mae declares war on the Federal Home Loan Bank of Chicago president, none other than Alex Pollock. Then Alex Pollock states, a real banker is someone who makes credit decisions and lives with them. When selling loans to the GSEs, the financial institution is really acting as a broker, as opposed to a real banker. Again, we saw the fruit of that in 2008. The Mortgage Bankers Association has growing concerns over Fannie and Freddie's new automated underwriting system initiatives that bypass lenders and move directly to brokers. We'll be hearing from Mike and see what his view is on that today. And then we have our own Tom LaMalfa, which is really a encapsulation of this issue. What Fannie and Freddie have done to mortgage lenders and are now trying to do to private mortgage insurers, remember, this is 20 years ago, could be done to your industries. You could be their next targets. And so that's really the underlying refrain of this concern over what's going on. Automation influencing real estate cycles. Scott Cooley was one of the early developers of a loan operating system and automated underwriting privately way back in, I believe, the 80s. And he wrote this in 2005 and basically talks about the downside of having a national underwriting standard that's controlled by basically one entity and how that will lead to instability, not stability, and exaggerate the upcycle and exaggerate the down cycle. And we'll see in a moment how the upcycle is being exaggerated even today. This next chart gives a little bit of background on just sort of some of these risk factors. These are debt-to-income ratios above 42. Automated underwriting in the GSEs along with FHA are the main methods for which these debt-to-income ratios go up and up and up during a boom cycle. Today they also go up and up and up because of the patch that was provided by the Bureau for Consumer Financial Protection back in 2013. But what we've shown here on the blue line is what the GSEs...
Do you want to put your graph on the slide?
Oh, I'm sorry. Yeah.
There you go.
The blue line the GSE loan share with DTIs greater than or equal to 42 started out very low in 1998 and then grew. It reached a peak of almost 45%, collapsed back down, not as low as it had been, but down to about 17%, and has now grown almost back to the peak that it was back in 2007. The red line shows how house prices have correlated with that trend. This next chart basically shows that DTI does matter. It particularly matters under stress. If you look at the bottom lines along the years back in the early aught years and late 90s, there is a difference in performance relatively between the low DTI and the high DTI, but the delinquency rates cumulative are so low you can't see it very well. And but when you look at it under stress, which the 2007 year is the example, and the dotted line takes it out to 2016 in terms of performance, so it's applicable, you see there's an 8-fold increase in risk from the 2000 cohort year to the 2007 cohort year. This last chart shows house price trend by leverage. The low price trend, which is largely consists of FHA loans, is going up very, very rapidly. It's about a quarter of the market. The next one, the orange one, is also heavily FHA, but not as much as the blue line, is about 28% of the market. So FHA is affecting about 50 to 60% of the market in terms of pricing, and then you have the rest of the market, the other 47%. And so this is constant quality. On the other side, you have market prices. In closing, we think that this is a cautionary tale for a return of the blob. Back in 2000, AEI released a study by Peter Wallison and Bert Ely that the growth of Fannie and Freddie posed a threat of a taxpayer bailout, and we think this is appropriate to make the same call again today. We may run into the same problem, and certainly FHA also has similar issues. Thank you.
Thank you, Ed. Tom.
Thank you. Good afternoon, conferees. It is a pleasure to be here. I've been looking forward to this presentation for some days now. My thanks to Alex and Ed for giving me an opportunity to share with you my long-standing connection with Fannie and Freddie. My presentation is something of a personal history. It was a history that was oftentimes painful, but more often than that, frustrating. In 1997, fresh out of graduate school, I accepted a position as a secondary market analyst for the Mortgage Guaranty Insurance Corporation, MGIC. In that capacity and for the next decade, I was the reader, writer, researcher for a whole loan placement operation. These traders placed loans from sellers to investors. MAGIC at that time was the nation's largest whole loan placement operation. In addition to running errands for the traders and their customers, I co-authored a weekly newsletter about the economy, interest rates, and mortgage market conditions and trends in both the private and the public sectors. For these same customers, I co-wrote MGIC's Guide to Secondary Marketing. The guide described how to use the secondary market to buy and sell loans. It included copies of all the pertinent documents, of course, but it also laid out the seller outlet options. There were private placements as well as sales to the Federal National Mortgage Association and the Federal Home Loan Mortgage Corporation, aka Fannie Mae and Freddie Mac. We have long forgotten the use of the word federal in their names. The guide contains sections on each of the GSEs, from the approval process to their delivery requirements, and lots of things in between, like programs, products, and underwriting requirements. Do you remember 2528 and 3336? I also helped to conduct training classes for customers and new employees. In the 1970s and 1980s, Fannie and Freddie were largely careful, judicious buyers with high credit standards for borrowers and higher standards yet for lenders. During the span of 20 years, their delinquencies were modest and defaults and foreclosures minimal, well under 2% and 50 basis points respectively. Beginning in the mid-1990s, I watched Fannie and Freddie shift to a much more aggressive market posture. For example, Freddie Mac's then CEO Leland Brenzel started talking about entering the subprime market. Meanwhile, Fannie Mae began lobbying and setting up so-called partnership offices in dozens of cities across the country. They also concurrently expanded their purchase programs to much less qualified individuals. As I saw it, Fannie and Freddie were using low-income borrowers to make themselves bulletproof on Capitol Hill. They had many critics at the time. From my vantage point, having studied some economics in college, I began to view the twosome as increasingly exhibiting duopolistic tendencies. In October 1996, I was invited to speak at the MBA's annual convention. The convention presentation outlined my problems with the duopoly and presented the case for their privatization. The criticisms I laid out for them in 1996 were sevenfold. 1, they were extracting the lion's share of revenue and income from the mortgage market. 2, they were commoditizing and nationalizing the mortgage market. 3, they were increasing the federal government's cost of funds. 4, they were creating mega liabilities with minimal capital. 5, they were exploiting their statutory position by lobbying for benefits and privileges for their managements and shareholders. 6, they were promulgating inner-city lending and then forcing lenders to repurchase the defaults. And last, 7, they were enjoying numerous advantages not shared by other firms, including being the de facto regulator of the industry. Among my MBA comments was this statement, and I quote, "What the agencies have been doing to lenders through the forced buyback of loans made under the affordable housing programs is scandalous. Monthly, lenders are being required to buy back hundreds of loans originated at Fannie and Freddie's request, no, at their pleas, to write more mortgages for poorer people and minorities. Originators gave them what they wanted, and now Fannie and Freddie are putting the loans back to your companies. Nearly every company has been hit by these buybacks. Simply put, the agencies want no risk, no losses, but handsome returns." End quote. Combined with other events, this purge also led to a painful shakeout among lenders, harmed many careers, and restructured the industry. From 1996 until the mortgage market meltdown, the Great Recession of 2008, I continued to warn lenders in Washington, D.C. about the risks and problems unchecked federal credit agencies were creating. I wrote dozens of letters to Washington notables explaining my concerns and asking them to check out my claims for themselves. I wrote to Senators Bond, D'Amato, Dodd, Graham, Schumer, and Shelby, and Congressmen Baker, Frank, Kasich, Leach, among others. Fed Chairman Greenspan, Treasury Secretary O'Neill, HUD Secretary Jackson, again, among others, also heard from me. I wrote always as a concerned observer, never accepting compensation for what I regarded as my duty as an informed, concerned citizen. In my letter of June 2, 2000, to Chairman Greenspan, I wrote about the inefficiencies of statutory duopolies and of their market power. Their leverage, incredible growth, and arrogance were all noted. I called them, and I quote, an anachronism, anti-competitive, too political, potentially harmful to taxpayers, bad for banks and other buyers of their debt and MBSs, bad for originators large and small, end quote. Further, I wrote, and I quote, "It is unconscionable for Fannie and Freddie to have so many lobbyists, to make so many campaign contributions, to pay themselves so lavishly, to make stealth legislative attacks on private industry, to invest in tobacco bonds, to advertise to the primary market, or to engage in numerous other questionable practices." I said that having read the charters and monitored their operations for decades. My letter to the Fed chairman concluded, I thank you, quote, I ask you to help reform Fannie and Freddie before they further fracture the U.S. mortgage market. The law of unintended consequences almost necessitates another FSLIC-like meltdown. That was 18 years ago. On March 3, 2001, I wrote to Secretary O'Neill, Treasury Secretary, to correct his misunderstanding of the word subsidy and whether Fannie and Freddie received them. Days earlier, Mr. O'Neill had been quoted in the Wall Street Journal saying that the twosome didn't receive government subsidies. My letter said, and I quote, "You mentioned in the interview that Fannie and Freddie don't receive subsidies. Few economists would agree with that statement. A subsidy is defined as a payment from the government for which it receives no goods or services in exchange. Subsidies can be implicit or explicit. Fannie and Freddie subsidies are implicit. They come from the value derived from their unique benefits, all of which are derived from the federal government. Among them are SEC exemptions, no state or local taxes, freedom from investment limits, use of the Federal Reserve as the transfer agent, unlimited debt capacity, freedom from investment limits, and a $2.5 billion line of credit from the Treasury. These are their subsidies. Neither firm pays the federal government anything for these benefits, but their benefits have market values that are untaxed, end quote. I wrote to Secretary Jackson in August of 2005. The Secretary had at the time been sending out all of these newsletters promoting the idea of homeownership. I suggested he stop advocating homeownership as the market was nearing collapse, adding that those he was now promoting homeownership for would be the first to be hurt. I wrote, and I quote, "People want to buy today to avoid paying more tomorrow. But with fewer homeowners able to afford their current residences and at today's prices, the likelihood of a 20 to 40% rollback in home prices by 2007 looms large," end quote. The meltdown in the mortgage market thus came as no surprise to me or to many of my colleagues. It had been building from the late 1990s until the mid-aught years. Home prices peaked in 2006, early 07, flattened, and then collapsed in early 2008. Peak to trough, the Case-Shiller Home Price Index dropped 40%. At the time, I was a partner in a boutique mortgage research company. We conducted examinations of wholesale and correspondent lending and did financial benchmarking of production revenue and expense in the various production channels for most of the country's major lenders. Third-party lending was a way for lenders to hold down costs. Our research business collapsed in 2008, along with the mortgage market and all the major lenders. Agency buyback demands brought them down, in the process again restructuring the market. My presentation contained an addendum entitled "Rouster of the Dearly Departed." It listed dozens of lenders, 62 in total, that had closed their doors. I was delighted in 2010 when President Obama and the Congress established the Financial Crisis Inquiry Commission, the FCIC. I came to Washington to attend all the commission's meetings over more than 5 months, on my nickel, by the way. I had great hope that the commission would conclude, as I had, that the crisis's prime mover and first cause was errant government policy. I listened. I was interviewed by the FCIC staff. I emailed the commissioners. I wrote a white paper built around a decade of contemporaneous observations that I had made in speeches, articles, letters, and in particular in a long-standing newsletter, the Home Mortgage Finance Report. The white paper was titled "Observations on the Mortgage Market." It contained a decade's worth of concerns about and problems with the GSEs. I was badly disappointed in the FCIC's conclusions, especially but not solely with the Democrats. Peters Wallison's dissent was really the lone exception. The other commissioners failed to understand the issue, or worse. Fast forward to 2018. A decade-long conservatorship continues. Little in housing policy has changed for the better, and once more, with memories fading, Fannie and Freddie, this time with the FHA's beckoning, are again expanding into new and risky mortgage programs and products. Ed and I recently co-authored an op-ed in the American Banker that outlined the problem. In a word, expansion, the blob. Let me conclude by suggesting that current housing policy is traveling the same path as in the aught years, only faster, thus lessons not learned. And 2, the best map to follow to reform housing policy and fix the secondary market is one titled The Taxpayers Protection Housing Finance Program. In some I watched firsthand, and what it often seemed to me to be in slow motion, as the mortgage market melted down. Based on the data that I see today, history is repeating in the mortgage business. And so I end on a less than cheerful note, but I do look forward to your questions, and I thank you for listening.
That's a great history, Tom. Thank you. Mike.
Thank you, and thanks to Alex and Ed for putting on this event. I do have some slides, so someone could pull those up and get started. First, a little bit about, there we go, about MBA. For folks that don't know about the Mortgage Bankers Association, we have about 2,300 companies as members, ranging across the entire industry. So single-family, multifamily, small, medium, large, banks, non-banks, credit unions, everyone who's involved in the mortgage industry. And it's really almost a remarkable consensus across that broad membership for the decades that, as Ed and Tom were describing, this issue comes up, agreement that Fannie and Freddie play an absolutely vital role in the system connecting global capital markets to Main Street, providing liquidity. They are absolutely vital, and we have a lot of members whose businesses couldn't operate without their existence. On the other hand, there's this constant concern that they're stretching beyond their defined role in the marketplace. And so that's the balance that our membership is always looking to keep. And a shorthand is that they are secondary market entities. Our members, for the most part, are in the primary market, and that Fannie and Freddie really are B2B businesses, not B2C, whether that C is a customer or a consumer. So the way MBA's often talked about it is a bright line, that in this conventional conforming space, there should be a bright line between what primary market entities do and what secondary market entities like Fannie and Freddie do. And if you look in the GSE charters, sometimes Fannie and Freddie will point to the first bold line here and say, look, here's what the charter says. It says we can't originate loans and we can't operate as a warehouse lender. We're not doing that. What are you guys complaining about? Right? That's the nature of our discussion frequently. And to us, there's that second bold line in the charter, which is equally important, if not more important, and it gets to what their proper role is. So they have a mandate in their charter to provide stability, so they are required to play somewhat of a countercyclical role in the market. And they're also supposed to, and this is straight from the charter, to respond appropriately to the private capital market. I'm an economist, right? So to me, that says, if there's a market failure, they should be jumping in, helping to solve it. If the private market's doing it on its own, the burden to jump in should be a little bit higher, right? That's the way I think about that. So MBA for, again, decades, going back to the history that Ed and Tom have talked about, has had this bright line policy, and we formally laid out this policy in documents in 1999 and 2001 and said, here's what we think is on the primary market side of that bright line. Here's what we think is on the secondary market side. So that's where we were. World's changed, though. It's changed quite a bit. So Ed talked about advent of automated underwriting in the 1990s. But technology today, everything's moving faster. So we're at a place now where the time from app to close for a mortgage is about 45 days on average in our data. We have a whole lot of lenders who are hoping to get that down to 10 days, right? And the time from when you close the loan to when you ship it to the secondary market, when you're dealing with paper, that's FedEx and 2-pound packages being shipped around the country. It takes a bit of time. We're moving pretty rapidly towards fully electronic mortgages, including e-notes that are just going to be traveling by wire, right? So the distance between the primary and the secondary market is shrinking. And so it's getting people sort of nervous and I think a bit more aware. And it's a reason to revisit this issue because what was a bright line in our documents in 1999 and 2001 is certainly becoming a little fuzzier now because the world's changed, technology's changed, capacity to do things have changed. But those companies that have staked their business on being a primary market business with Fannie and Freddie operating to support that in the secondary market are worried by some of the GSE activities which look to be impinging, again, given some of the capabilities that they have with some of the new technology. Now, this is absolutely not to sound like a Luddite, right? The technological improvements that are being put in place are really very favorable. And there's some, I point out here, the front-end QC technology that Fannie and Freddie have in place now. So lenders will send a loan in, and almost immediately they can be tracking any defects which are picked up by Fannie and Freddie when the loans are shipped and get that first review. and have an ability through a back and forth process electronically to fix and clarify and document exactly what the status of those loans is. And you've got to give credit to Ed DeMarco here for sort of pushing the industry in this direction. And the reason for doing this, and to Tom's comments, is the old process of you send in the loan, they buy it, 5 years later they knock on your door and saying you made a mistake on page 458, you need to buy it back. That didn't work very well. And so technology to address that makes all the sense in the world. But that is a purely secondary market technology. That's interfacing between the lender and Fannie or Freddie. And again, I think they're doing a really good job of that. Another example, the CSP, the Common Securitization Platform. Really cutting-edge technology, improving the securitization process. That's fantastic. It's fully a secondary market function. So what are the problems? So this is sort of a bill of particulars, so some recent issues that various parts of our industry have had with some GSE actions. And again, the wonderful aspect and the challenge of having such a broad membership is you can find some of our members that are in favor of any one of these items on here. You can find some of our members that are against any of these, right? But looked at in totality, the sense is the GSEs are pushing up and beyond the bright line that MBA has identified in the past. So what are the kinds of problems that we're focusing on? So one of the GSEs had a pilot program marketing low down payment loans and then providing a referral to a lender if a customer looked or a consumer looked at that marketing. If you were first on that list, you likely were going to get the call. How do you know whether you're first on the list, right? That was a little bit in the background. And why is that GSE directing a customer to a particular lender? This whole notion of picking winners amongst the primary market is really problematic. We made our concerns known about that, and as my understanding, that pilot was stopped. But in a world where it's unclear that something like that goes against the bounds of the charter, I think, again, it really says that Congress and the regulator need to weigh in on exactly what the rules are. Second item, a GSE rolled out a particular technology program and chose a single vendor with the launch. That single vendor, given a monopoly for a key interface between the primary and the secondary market, proceeded to jack up their fees, earn enormous profits. No other vendor was given the opportunity part of that launch, right? So again, picking winners in the primary market. Third, this was in the news, a GSE that was providing financing for mortgage servicing rights for certain select lenders. No transparency as to who was part of it, other than a couple of very large lenders that we were familiar with. The other GSE in this case actually spoke out and said, this is not a case where the private market's having a problem. There are plenty of warehouse lenders that provide that financing. And this actually gets close to, is this warehouse lending or not? I'm sure they had lawyers saying it wasn't, but warehouse lenders perform this function of financing mortgage servicing rights. The fourth one, so I think Ed mentioned the Imagine program and the EPMI program. So new approaches to putting credit enhancement on loans. MBA's 99 and 2001 documents really viewed primary market credit enhancement as, again, a primary market function. So this one really raised a lot of questions. And so we wound up sending a letter to FHFA really highlighting the list of questions that we think this raises. This is one where I think there's a fair amount of debate amongst our membership as to whether this is truly a stepping over the line or not. And I have to commend Fannie Mae with their launch of EPMI. This issue about not being transparent is in some ways the worst part about it. You hear news of the GSEs launching some new activity, launching some new program, and you hear about it through industry blog or through media coverage. There's never any good transparency about what are the roles, what's the aim of the program, what's the timeline of the program, who's involved in the program. And again, I think this is a case where EPMI was done much better than Imagine in that respect. It's not just our single-family members that are concerned. Alex mentioned that Freddie Mac is talking about being the largest multifamily lender. Again, that would rub some people the wrong way. They're not a lender, right? They're a secondary market purchaser of loans closed by somebody else. And we've had all kinds of concerns of both GSEs meeting directly with borrowers, looking like they're trying to cut out the lender from the deal. The last one, a continuing concern, and it gets to some of the countrywide quotes that Ed had, of, again, picking winners. If a GSE is reaching down and providing more than competitive pricing or special credit variances or other competitive advantages to one lender in the primary market, and that's allowing them to gain share, that's driving somebody else out of business in a really unfair way in a government business. So this is a list of questions. Some of this comes from that letter I mentioned to FHFA on the credit enhancement programs. Just saying, is there a way we can go about this in a more transparent, more principled way? One is just to really be open about what pilot programs, what new activities are either being considered or are operating right now. Even just a simple question of, can you provide us a list of the current pilot programs that Fannie and Freddie are operating right now? And the answer was no, right? Which is kind of shocking. But from a direct question like that, again, that's sort of the least of what you can hope for, I think, here. Again, we get really concerned representing the whole industry that we want a level playing field for our members. This is a very competitive market, 6,000 mortgage lenders operating. You shouldn't be providing sort of untoward advantages for one or another in a very, very opaque way, and that's happening more and more through some of these new programs. So some of the recommendations that we gave to FHFA, one on this technology aspect, really important that rather than launching with a single vendor that the GSEs might go out with, here's a set of criteria, here's what we're trying to do. Who has capabilities to try to meet those criteria? And in this technology space, I think that's really very important. The second, again, these activities are launched, these pilot programs, and it often comes as a pilot program. Develop a way for reviewing whether these meet the terms of the charter, both the does it involve originating loans, is it warehouse lending, but also this broader sense of, is it appropriately supporting the private market? And that would go for pilot programs as well as for any proposed new activities. And my sense right now is that FHFA has been more focused on a safety and soundness review and a relatively narrow, is it legal review, right? Does it from a legal sense violate the charter as opposed to does it meet this standard or does it appropriately support the private market? Last point I'd make, and this gets to actually the proposal that...
I'm glad you're on the last point because you have 1 minute.
Excellent. That Ed and others at AEI made where it was really, really focused on shrinking the size of the GSEs. So, Ed mentioned cash out refinances, other programs, other products, concerns about credit. Just from an industry point of view, that's not where we are. That our focus really is on the scope of activities that Fannie and Freddie are involved in, and do those follow or really violate the spirit of the charter in terms of appropriately supporting the private market. In terms of the footprint of where are they competitive and where are they not, this is really interesting. Again, if you look to sort of news of the day, particularly for loans like investor loans in the conforming space or high balance conforming, private label securitization is beating by about 2 points in terms of execution what is the execution for a GSE securitization. So certainly expect that the market is going to nibble around the edges there in places where they can be more competitive. And that's probably the better channel for managing the footprint of the GSEs in terms of their size, is making sure that the private label market is willing and able to take up more business over time. Because again, certainly investors certainly seem more than willing to take on some of this business. And if you look at some of the PLS issuance so far this year, 40-50% of what's being securitized through these pools are loans that would be agency eligible. So the private market is taking some business away.
Thank you. Norbert.
Thank you. Good afternoon. The title of our event today, as you know, is Should Fannie Mae and Freddie Mac be shrinking or expanding their activities? And the answer, of course, is yes, they should be shrinking their activities. Unfortunately, what they're doing is the opposite. They've been expanding their footprint in the market. So what I'm going to do is just cover sort of my own list of what exactly it is that they've been doing to expand their footprint in the market. I have a list, of course, but it's not a comprehensive list, but I think it's a pretty good start. First thing, they've been doing more and more high DTI loans. Dodd-Frank, as you probably remember, most of the people here are aware, imposed certain ability to repay standards for residential mortgages, directed the Bureau of Consumer Financial Protection, the BCFP. That's really hard to say now after saying CFPB for 8 years, but that's what it is anyway. So they were directed to develop a qualified mortgage rule so that any QM would automatically meet those standards and you would automatically be in compliance with the ability to repay. These are supposed to be safer mortgages, and the base QM had features such as a maximum DTI, debt-to-income ratio for the borrower of 43%. That feature was explicitly singled out in the Bureau's final rule. However, the final rule also included a temporary QM category known as the patch, and under this provision, which is set to expire in just a couple years, 2021, mortgages for borrowers with a DTI in excess of 43% could still count as a qualified mortgage, provided that they were eligible for purchase by a GSE or another agency and met some of the other, but not all, some of the other QM requirements. The patch was supposed to be a temporary provision, and that's in the rule. It's stated very clearly in the final rule. It was supposed to provide a transition to the base QM along with the maximum 43% DTI, also flagged specifically in the final rule. But the patch has become nothing more than a way to expand the use of the high DTI loans. Since this rule was finalized, the GSEs have started purchasing mortgages with DTIs as high as 50%. Privately, industry insiders insist that the FHFA directed the GSEs to do this, to raise the max DTI. Not sure, but that's what they say. Regardless, they've done it, and they've expanded their purchases. These have ebbed and flowed. Ed had a graph earlier in the presentation. Ed had a graph that showed how these have gone up and down in terms of the percentage of their purchase loans. If we fast forward up to January 2013, at that time, the GSEs had just about less than 15% of their purchase loans with a DTI above 43%. And now, or by the end of 2017, it was just under 30%. That mirrors very closely what happened at just before the crisis in 2007. And the problem with that, of course, is that that's exactly when the DTI loans blow up, is when there's a stress event. So if we come to the end of the cycle, we're about 2 years out of the typical length of a home price boom right now. If that happens, we've got many, many more high DTI loans in the system. My second item is the expansion of the multifamily business. And Mike spoke a little bit about this. These are rental houses for 5 or more families, for those of you not familiar with the multifamily stuff. Growth in multifamily mortgage debt has far outpaced the growth of multifamily housing units. And that debt has been fueled by the GSE's expansion of their multifamily business, in some cases direct and blurring the line between the primary and secondary markets. In others not. They've expanded, though. Freddie recently announced that it had grown its multifamily guarantee portfolio by 30% from the first quarter of 2017 to the first quarter of 2018, and that went up to $213 billion. Fannie, very similar in dollar size, grew its portfolio about 11% from the first quarter of 2017 to 2018 to about $280 billion. Providing government guarantees for multifamily lending is corporate welfare and crony capitalism. It's just plain and simple. We don't need to be subsidizing housing developers. If we want to give assistance to renters, and I'm not saying we should, but if we do, we could do it directly. It would be more efficient, more effective, and it would make a hell of a lot more sense. Just in case you're wondering what I'm thinking. Third, Freddie started offering lines of credit. Mike also touched on this one. Specifically, they started providing lines of credit to non-bank mortgage companies to assist with their mortgage servicing operations. Allowing Freddie to provide these loans, which are historically provided by commercial banks, it puts them and the federal government in direct competition with private commercial banks. And the same would hold for Fannie if they started doing this. And if history is any example, they'll start doing this soon. They always follow in each other's footsteps. The charter does not include an explicit prohibition against doing this, against this type of lending, but it does include one against direct lending to fund mortgages. The whole point of that provision is to keep them squarely in the secondary market. This clearly violates that idea. At best, these credit lines blur that distinction. When you're offering the same exact product that a commercial bank's lending, it's pretty hard to argue you're not expanding what you're doing. Fourth item, they've started directly competing with, in my view, they've started competing directly with the PMI companies. Freddie Mac and the Arch Capital recently announced their pilot program. They pitch it as a new form of risk sharing. They say that it will boost investors, this is a quote, appetite for low down payment mortgages. That's great. The program is, as you've heard, called Integrate Mortgage Insurance, or Imagine. And under this program, they select insurance at the loan level, and they appear to effectively control pricing and coverage determinations. And I say appear because the details on this are still a little bit fuzzy. As Mike mentioned, it's hard to get a lot of answers out of FHFA or Freddie on this. But again, these are functions that are typically performed on the primary market. So at best, again, they're blurring the line between secondary and primary markets. Looks very much like an end run around PMI companies. And of course, Freddie has a very long, tumultuous history with the private mortgage industry. One could make a case that they have wanted to become the world's largest PMI company, or something else, maybe like a lender, I don't know, but it's definitely in their history. And then just the other day, Fannie Mae announced their own. That's the Enterprise Paid Mortgage Insurance, EPMI. They openly admit that they are offering another option for obtaining mortgage insurance to satisfy Fannie Mae's charter for high LTV loans. That's how they're expanding their footprint. And with this option, the MI premium will be paid directly by Fannie Mae. If I worked for a mortgage insurance company, I would be very worried. More so than if I was a non-bank lender, but if I was working for an MI company, I would be very worried that they're trying to take over my industry. My fifth item, increased use of credit risk transfers. In 2013, under Ed DeMarco, Freddie Mac completed the first of several deals that were designed to transfer credit risk from the GSEs to the private sector. And Ed can correct me if I'm wrong, and he should. But the way I took that stuff back then was that these were viewed as a step towards shrinking the GSE's footprint. They were a way to get more private capital involved. And they were new, and in theory, it made sense to try anything new to shrink their footprint. They were defunct or broke, supposedly. And it's pretty clear now that they're doing the opposite. Those credit risk transfers, those CRTs, are doing the opposite. They've become little more than a way to borrow more money to expand their operations, that is, the GSE's operations. Or from the other side, if you want to look at the other side of that transaction, a really good way to invest in a great debt security with treasury security, safety, yet probably a lot more in return. So it's good to lend the GSE's money through these if you can. Basically, these are just structured debt securities, and the GSEs borrow money paid back to the investor in a manner tied to the performance of underlying mortgages. So in theory, if too many people stop paying their mortgage, the people who lent to the GSEs will not get paid what they had been originally expecting, and they'll lose money. But there's a catch, or at least one catch. First of all, they're structured so that investors have none of the tail risk, and they end up with a very low probability of losing any money in the middle as well. The credit losses on mortgages are measured net, at least for some of these, are measured net of any payouts from private mortgage insurance companies, and it would take, even in the absence of that, the PMI portion, it would take a massive credit event for any of these investors to lose money. Anyone can go and look at the prospectus for these things online. They include risk projection tables that lay these grids out. They're there. Anyone who wants to invest can look at this, and you can see by the company's own projections, you would have to have constant default rates for years that are well above their worst years that they've had for the investor to really lose money. So this is a way of borrowing more money to expand their operations, and this is really doing very little to transfer any risk to the private sector. The sixth one that I have is an increase in total portfolio. of both Fannie and Freddie. A very big deal has been made recently in at least one conference that I was at, American Action Forum, that the GSEs have shrunk their mortgage portfolio so they're much safer. And it's true, they are holding lower amounts of mortgages. However, they're holding more mortgage-backed securities. Just as an example, if you look at Freddie's balance sheets, their 10K reports over time, from 2012 to 2016, Freddie increased its holding of Freddie Mac mortgage-related securities, that's their own securities, from about $1.5 trillion to just under $2 trillion. Freddie's total portfolio has actually increased, not decreased. It's only the mortgage portion, the direct mortgage portion, that's decreased. Fannie's balance sheet is a bit harder to decipher, but in 2012, their total portfolio was just under $3 trillion, and by 2016, just over $3 trillion. So they kind of look like they're doing the same thing. Initially, the FHA acted very much like a federal conservator should. I think it tried to protect taxpayers and shrink the footprint of the GSEs. Under Mel Watt's stewardship, they've been doing the opposite of that. They've been expanding their role, and as far as I can tell, the FHFA has now been doing pretty much all it can to justify its own existence. 1 minute. So really fast, why should they be shrinking? Aside from taxpayer risk, they should be shrinking because what they're doing is not counter-cyclical, what they're doing is pro-cyclical. We're in a 6-year-old house price boom. Interest rates are rising. Home prices are above their pre-crisis peak. Home prices are going up faster than they have in 2005. They're going up faster than income. They're going up faster than the fundamentals. And a large portion of that rise can be attributed to the increase on the demand side, the increase in high leverage loans. That's what these companies are doing, and they're doing more of it now than they were before.
Thank you, Norbert, for the very nice brief for the prosecution. Mike.
Great, thank you, and thank you for inviting me here. I do have a solution for the BCFP kind of issue. It's the same solution that I use for National Airport. When it became Reagan National Airport, I just still call it National Airport, and I will never call it that. And to me, it'll always be CFPB. So you've got to approach the questions that were posed to the panel with a worldview, and if you adopt Ed's and Tom's kind of blob as your worldview, you can answer the 4 questions that we were asked that are really motivating this conference, this panel, in 1 or 2 word answers. Should the GSEs be shrinking their activities or expanding them? Shrink. How can private capitalists compete with their infinite leverage, broad regulatory exclusion benefits? They can't. What kind of regulatory approval should be required before they exploit these powers in new products? Very strict. 4, can a future capital regime address the market distortions Fannie and Freddie otherwise create? Sure. Run them through receivership and eliminate the government guarantee. Now, my worldview is different, and so I would approach these questions and issues around the conservatorship differently. And so what I'd like to do is just touch on several of these and just give you a sense of those things I think are very positive that have happened in the conservatorship and those things that are kind of more problematic. I would argue, and I know it's a minority view certainly on this panel, but when you have a net worth sweep, how you can say the government guarantee is free is beyond me. The government is taking every penny of profits of the GSEs. There's $250 billion of capital backing them. Whether that capital is attached to the MBS and the corporate debt that allows the GSEs to continue raising capital and supporting the market, their guaranteed securities, or it's on balance sheet, the net effect is the same, and I would argue that they don't have infinite leverage. I'm encouraged by the capital rule that was put out for public comment, It has a sensible leverage ratio. If you look at how the GSEs have been pricing, they've been pricing, even though you could, whether you want to call it vapor capital or virtual capital, they're pricing as if it is real capital. If you look at their G fees today, given the corporate tax cut that hasn't resulted in a reduction in G fees, one could argue that they are actually pricing their G fees at SIFI levels of capital. So I would argue about the infinite leverage and free kind of government guarantee. The market share issue I would agree with. They have increased market share in the multifamily to 60% of the market, over 52% 2 years ago. And to me, there ought to be better targeted multifamily with the affordability issues there are. To me, they ought to be far more targeted on there. Now, to be fair to the GSEs, most of that growth, as you know, there's a cap on multifamily business, and then there's an exemption to that cap, and the exemption is affordable, and that exemption category has had kind of mission creep, and included under that exclusion cap today is the green products, and a substantial portion of the growth in their multifamily activity is in the energy related green products. I can't say whether or not they're displacing other capital in that category or not, but I would tighten the exclusions, and I wouldn't brag about increasing kind of market share and being the number one as others have agreed. So I would agree with that. I would also agree the lack of transparency has really been a problem, really kind of across the board. When I was in the the previous administration, the fact that Fannie and Freddie continue in conservatorship to be private companies with proprietary business kind of data and interest and processes that are respected in conservatorship, more so under Milwatt than under Ed, where there really was a much more kind of explicit path toward reducing the role of the GSEs than there is today. The lack of transparency and pricing and capital and cross-subsidy and all of these things certainly have complicated the conversations around housing finance reform, and I would agree that we need a whole lot more transparency. There's really a real interesting issue around the concept of going concern. I'll call it a going concern issue. Clearly in conservatorship, you can't define the GSEs as going concerns. However, if you look at some of what has gone on in conservatorship, I'll give you an example. Both GSEs continue to develop really powerful and important intellectual capital while in conservatorship. In the last 3 years, for example, Fannie has filed and received 3 patents dealing with collateral evaluation and appraisal. If you just, and this is a quick review that I've done. Since they've been in conservatorship, Freddie has filed and received more than 20 new patents, bolstering their intellectual capital, their proprietary intellectual capital, while they are taxpayer-backed entities. If you think about the investment in the common securitization platform, which I think is an enormous and ought to be ultimately a market utility and the kind of backbone of kind of a reform system, you could argue with the sweep that this has been really a taxpayer-based investment in the most modern, replacing obsolete plumbing and infrastructure with really the most modern and up to date. And when Ed's original strategic plan called for the CSP to enable more competition and to have a non-agency execution, and when Mel came in to narrow that priority on the development of the CSP to serve first and foremost the securitization needs of Fannie and Freddie, to move to the single security, certainly that strengthens and embeds Fannie and Freddie kind of into the fabric, of the housing system, more so than a building more capacity of the CSP to accommodate other guarantors and a non-agency execution. Mel Watt has said, my job is not to really talk about legislative vision for legislative reform. That's the role of Congress. The reality is, come last January, after many requests at hearings and so on, when FHFA sent their vision for the future, that vision, includes a reformed Fannie Mae and Freddie Mac operating with private capital, regulated as private utilities, and as going concerns. And if you kind of, in retrospect, look at critical decisions that are made along the way in the conservatorship, one could surmise ex post that many decisions that are made in conservatorship by the conservator are in line with a vision for the future, and that vision for the future involves a continuing role in terms of the current direction of the conservator for Fannie Mae and Freddie Mac. And the irony, from my standpoint, the irony and the net of what has taken place under both Ed and Mel's leadership is that Fannie and Freddie are leaner, meaner, stronger, and really more capable of playing a major role in the housing finance system for many years to come, be that in a enduring conservatorship or in a future system. And let me just stop there.
Thanks very much, Mike. Great job for the minority. Ed.
Thank you, Alex. Thank you to AEI for the invitation to be here. Thanks to my fellow panelists. I've enjoyed listening to the different perspectives. There's so much one could talk about with regard to the general topic of should Fannie and Freddie's footprint be growing or shrinking in conservatorship. I'd like to limit myself to just having two takes on this. The first is really about does or should the conservator care about the size of the footprint, or maybe to put it differently, I like Mike Stegman's frame at the outset of his remarks about the importance of worldview. And I think that in what I'm going to go through, you'll see how that matters. I think it also matters, with regard to context and timing. What is the environment in which one, adapts this worldview? Certainly, the environment when I took over as acting director in the summer of 2009 was different than when Director Watt took over in January of 2014. And then the other is, I just wanted to focus on one area that is, to me, a key driver in what a footprint looks like now and going forward. It's a regulatory issue, and how a regulator might, how they look at this particular lever and how it might affect, the footprint, and that is capital. All right, capital, return on capital, the pricing that evolves from the decisions you make about capital and target return on capital. Are you running the conservatorships to mimic a private regulated financial institution that should be allowed to fail? Or are you running the conservatorships as special entities designed to be protected and use their status to subsidize housing finance? In the infamous words of a former chairman of the House Banking Committee, perhaps roll the dice a little towards subsidized housing. So let me go through these two things, the conservator view about the footprint. So we've had 3 directors of FHFA while in conservatorship, and we each took over in sort of a different environment and had a different bit of perspective on this, even though we all operated under the same legal statute. So on day 1, year 1, when Director Lockhart, announced that FHFA was putting the companies into conservatorship, there was a real critical objective at that time, and that was to assure global markets that they could still buy and trade GSE securities. It was to inspire confidence domestically in our housing market, and it was to even, in the context of the financial market turmoil in the United States, there was an explicit provision at the start of the conservatorship to allow the portfolios of Fannie and Freddie to grow, giving the government time to gear up its own systems for doing that. So we all are familiar with the preferred stock purchase agreement having a wind down of the portfolio, but how many remembered that on day 1 the idea was that the portfolio would actually grow as one of the tools for trying to introduce financial stability? So that's day 1. The next phase, in terms of FHFA position on this, came 17 months later. It was February 2010. It was about 5 months after I had succeeded Director Lockhart. And at that time, I wrote a letter to Congress. It was not solicited, but I felt like it was critical for me to explain to lawmakers, how I was viewing the role of the conservator. And it also was done in recognition of some growing discussion and pressure for how to use the conservatorships for all kinds of activities. So I wrote a letter saying that I wanted to provide some transparency on the future direction of Fannie and Freddie business activities while they were in conservatorship. I focused on 4 issues: loan mods and loss mitt, reducing the retained portfolio, new products, and the affordable housing mission. I think in the context of the theme of this, I wanted to recite what it is I said in 2010 about new products. I wrote that after considering the statutory requirements and the goals of conservatorship, I've concluded that permitting the enterprises to engage in new products is inconsistent with the goals of conservatorship. Therefore, I'm instructing the enterprises not to submit such requests. I believe the enterprises should concentrate their existing core business, including minimizing credit losses, and I reached this conclusion as various proposals seek enterprise involvement that even if within charter limitations could require large expenditures of funds, enter into new business lines with little prior experience, or dedicate personnel already operating in a stressed environment. It would also require new risk measuring tools, compliance procedures, and additional oversight from FHFA. In short, will limit the enterprises to continuing their existing core business activities and taking actions necessary to advance the goals of the conservatorship. This type of limitation on new business activities is consistent with the standard regulatory approach for addressing companies that are financially troubled, and it is even more pertinent for the enterprises given their uncertain future and their reliance on taxpayer funds. The next phase came 2 years later. In February 2012, FHFA issued a strategic plan for the conservatorships. And at that point, I felt like we needed to update, what we told Congress and the public about these conservatorships. And we wrote that with the conservatorships operating for more than 3 years and no near-term resolution in sight, it's time to update and extend the goals of the conservatorship. We're contemplating our next steps in how to build an infrastructure for the secondary mortgage market that is consistent with existing policy proposals and will support any outcome of the leading legislative proposals. And just to remind everybody, the leading legislative proposals being developed at this time range from Jeb Hensarling to Maxine Waters, but they had a lot more in common than people understand, and they all, including with the administration, had a consistent view that the goal was to gradually wind down Fannie and Freddie. What replaced it and how that was done could be different, but there was a lot there that was in common. So we put forth 3 strategic goals for this next phase of conservatorship. Build, contract, and maintain. We were going to build a new infrastructure for the secondary mortgage market. We were going to gradually contract the enterprise's dominant presence in the marketplace while simplifying and shrinking their operations, and we were going to maintain foreclosure prevention activities and credit availability. So the ways to gradually contract that we talked about included G-fee pricing, credit risk transfer, more reliance on mortgage insurance, caps on the multifamily business, and managing the wind down of the retained portfolio. With regard to building, we said we were building a market, not the enterprises. The goal was to create a competitive private market for mortgage credit risk. And so this is where this sort of worldview thing starts to matter. We wrote at the time that, as with the securitization platform and the things we're doing here, the goal is not to rebuild Fannie Mae and Freddie Mac, but rather to leverage the experience and human capital expertise at these firms to build a new infrastructure for the future. The goal is not a proprietary system, but rather an open system that promotes competition and transparency while forming a basis for a stable, liquid, and efficient secondary mortgage market. And then, I went back through, I'm not going to read any more like that to you, but I gave quite a number of talks those last few years that I was acting director, and in every one of them we talked about this notion of gradually contracting the footprint, gradually building a competitive private marketplace for mortgage credit. And so that's what, the vision, that I saw and what we at FHFA at the time saw with regard to conservatorships. The next phase began in 2014. In May of 2014, Director Watt gave a speech at the Brookings Institution in which he announced a new strategic plan for FHFA, and he directly acknowledged a change in focus from the prior regime. He said the focus is going to be on managing the present. It will not be on housing finance reform legislation, and both by implication and by action, it was not on assisting or anticipating any such legislation. So the goals were now, rather than build, contract, and maintain, it was maintain, reduce, and build. And the reduce was to reduce taxpayer risk. Director said we've reformulated the goal from contract to reduce so that it no longer involves specific steps to contract the enterprise's market's presence, which could have an adverse effect on liquidity. Instead, the reduce goal focuses on ways to scale back Fannie Mae and Freddie Mac's overall exposure. And with regard to the securitization platform, Director Watt clarified that the agency's top objective for the common securitization platform is to make sure it works for the benefit of Fannie Mae and Freddie Mac. That's a direct quote. Building a CSP for a future housing finance system that is not yet defined is extremely risky and could add needless costs. I go through this just because I think that having this understanding matters. So, what we're talking about today about footprint, in some sense, shouldn't come as a surprise because this perspective has been well established by each different conservator. A new strategic plan was issued in 2014 that changed again. In just 6 months, the reduced goal vanished entirely, and it's now ensuring safe and sound entities, ensuring liquidity, and managing the conservatorships. A new strategic plan in 2018 has the same strategic goals. So as we think about a new FHFA conservator, new FHFA director next year, this will matter, right? I mean, the new director, whoever this person is, will bring a worldview. The interesting thing I'd say about these various strategic plans is the first few pages of every one of them, the text is identical. Why is that? It's identical because each of them cite the various statutory provisions that motivate FHFA. So the same statutory provisions that motivated my view and the things that we did is the exact same ones at FHFA. And I think that this suggests something about, A, this is not to make it right or wrong, but that perspective matters a lot. And B, at the end of the day, this really is about our elected officials needing to make these determinations. Okay, the other thing I wanted to talk about is this lever about capital. Am I down to my last minute? Okay, very good.
You're saying things
All right.
that are so interesting, Ed, that we're giving you 2 minutes.
Thank you, Alex. That's very kind.
fair.
No, it's not fair. It's not. I've learned life is not fair.
But
let me
only 2
see.
minutes.
Okay, thank you. Most of you know FHFA recently released a proposed capital rule for Fannie and Freddie, and I want to say that this should compel all of us interested in these issues to think deeply about the proposed rule and its implications. For myself, I'm still immersed in studying the proposal and discussing it with HPC members, so I don't have final conclusions to offer except for this. This rule is much too important and far too complex to be digested and commented on in 60 days.
Agreed.
You know, a grave failing of the pre-crisis regulatory regime for Fannie and Freddie was a regulatory capital framework for the GSEs that was divorced from other regulatory capital standards and from the risks associated with mortgage assets. So an important housing finance reform principle that HPC, MBA, and others have had is the need for a more level playing field, some sort of capital equivalency across regulated financial institutions engaged in housing finance. So a critical question in evaluating this FHFA proposal is whether it perpetuates substantially lower capital requirements for the GSEs relative to banks and insurance companies or not. And so there's at least two elements to consider there. If the GSE has a capital requirement of X for a mortgage, would an insurance regulator or a bank regulator also assess the requirement at X, or 2X, or 3X, or maybe even 4X? And second, you know, in our post-financial crisis regulatory framework, we've utilized a concept of a systemically important financial institution, or SIFI, to judge whether systemic risk warrants an additional and substantial level of capital protection. So given what happened in 2008, the systemic relevance of Fannie and Freddie should be self-evident. Given that, does the capital rule that's been proposed provide an equivalent level of added protection for systemic risk? So this is important, that even if this rule is suspended while in conservatorship, if these capital levels are supposed to drive the business decisions of Fannie and Freddie, that they're supposed to impute having this much capital and a target return on capital in making their business and pricing decisions, this is going to directly affect what that footprint going forward looks like. Because if this is materially different than what real private capital competing in this marketplace for mortgage credit would have, then that imbalance is going to lead to the footprint growing and not shrinking. So let me leave it there.
Thank you. Well, we know from Fannie Mae's own testimony that they were already a SIFI, although we didn't have the term, but they were already systemically important in 1983, let alone 2008, and let alone 2018. I want to give the panel, because a whole lot of really interesting things have been said by everybody, but each two minutes, and here again I really mean 2 minutes. I'd like to just go down the road and see if there's something you want to add, you want to react quickly to what somebody else said, or clarify a point. We'll just go in the same order, max 2 minutes each. Ed.
Okay, I'd like to react to something that my friend Tony said, where on that last slide that said the market could shrink Fannie Mae on its own because it can compete. I think there are two problems with that. One is that Fannie and Freddie both follow what the primary market is doing and who's holding what very closely, and then they look at what gets sold into the secondary market, and they basically say you can't hold back things and you can't sell us this and not sell us that. Now, they have different rules for that. But secondly, what requires that is this very opaque and expensive cross-subsidy regime that has been set up and has expanded very tremendously in the conservatorship since the original conservatorship. That's now about $4 or $5 billion a year that gets moved from low-risk borrowers to high-risk borrowers. So the more low-risk borrowers that taken out, the more Fannie and Freddie have problems keeping the cross-subsidies going. So what the co-authors of the reduction plan, the administrative solution reduction plan for Fannie and Freddie, and I have proposed is let's start with things like the cash-out refinance, which don't seem to serve any particular public policy purpose, and why should Fannie and Freddie be doing those very risky loans and during a boom to get riskier? We already know they've established, along with FHA, bad faith in this area because the debt ratios have gone up for cash-out refis. Why in the world would you have that happening? These are people taking cash out, and you're going to give them higher debt ratios under the patch? Makes no sense. Is that 1 minute or 2 minutes?
That's two.
Two. Okay. Thank you.
Thank you. Tom?
Okay, there's more brain power up here than I can handle. So mine are in the form of questions. This whole group everyone's got PhDs here except. My first question really goes to Ed DeMarco, and your comment about you felt that it was inappropriate for the FHA to allow Fannie and Freddie to innovate by adding new programs and products. Was there a statutory basis for that, a legal basis? I mean, why did you come to that conclusion? And then my other question is really as much a comment, and it's for both Norbert and Michael Frattantoni, who made comments about competing under the financing plan that Freddie Mac initiated a couple of months ago. And it's my understanding in talking with some of the members of the pilot program on that it's really not a level playing field in terms of competition. I mean, I'm specifically told that we were borrowing at LIBOR plus X, and that now we're borrowing at LIBOR plus X minus 200 basis points. So there's not a level playing field there, and it's not competitive. Again, it's anti-competitive. And do you concur with that?
1 minute each to reply. Ed?
Yes.
So, no, I mean, the statute that created FHFA required FHFA to actually draft a regulation on an approval process for new products. And that regulation, actually, FHFA did it, and did it pretty quickly after we were created. The point of my going through this in my letter was to say that I was directing the enterprises, that's fine, the rule's there, I'm not going to accept new product applications from you. And the reason, it was a regulatory one. And as I said, the standard regulatory approach for addressing troubled financial institutions is you don't let them get into new business activities, take on new lines of business, new risks, and so forth. I wanted the companies very much focused on the core requirement of minimizing losses on their credit book, so we minimize losses to the taxpayers, and ensuring that the securitization market for single-family loans continued. And I didn't want to be developing, new products, new lines of business they did not have experience in, and that was the basis for it.
Thank you. Mike, 1 minute.
Yeah, I mean, I mentioned the importance of a level playing field to MBA. So when Ed DeMarco was the acting director, we made a big push with him to try to ensure that G fees were level across all sellers and servicers to Fannie and Freddie. Made a lot of progress there, but we keep finding sort of rabbit holes where the playing field gets unleveled, whether it's buy up and buy down grids, or in this case, providing, like you're saying, several hundred basis point lower MSR financing, that's equivalent to a much lower G fee. And that's back in the world that you were talking about in the 90s and 2000s, where Countrywide was, 30 basis points below your typical lender.
Yeah.
Well, you've got the floor, Mike. You can go ahead with other comments if you have some.
Yeah, just a couple. Norbert and others have mentioned the importance of the patch. I think it's critically important that some of the DTI differences that Ed's mentioned, others have talked about, other credit variances are allowed under the patch, not allowed elsewhere. And I guess so you have two choices. Either you get rid of the patch and everyone's held to a very rigid level, or everyone gets the patch. I think those are the two choices. The one we're in right now is really not feasible. Reacting to something that Michael Stegman said, like you said, an incredible amount of brain power at Fannie and Freddie. There's a lot of very smart, hard-driving, entrepreneurial people. The question is here, are they being directed in the right way, right? Mm-hmm. And the number of patents. And just the worry right now is just this moment in time right now, like I harped on in my comments, we're in this phase where the technology is changing so much, and they are laying track to change the market going forward. And we just got to make sure those tracks are heading in the same direction, not just for their good, but the good of the broader market.
Thank you. Norbert.
So I think, Tom, we might have been saying the same thing because I'm saying that it's not a level playing field. So when I'm saying competitive, I'm saying they're competing with someone that they can't compete with. So that's what I meant by that. I've got the floor.
You do?
Okay.
You do.
One thing really quick to something Mike just said. So my wife doesn't pay very close attention to anything I do.
That's normal.
Work-wise. She finds it very boring. But anyway, occasionally we do talk about stuff, though, and when we're talking about this issue, I specifically said something about this 43% DTI thing. So something that could be characterized as very rigid. When I told her about the 43% DTI deal, she looked at me like I was nuts, and she said, who the hell would do that? That's crazy. Who would want that loan? So I mean, I know 43% DTI is not rigid, so we're done there. Like I'm not going there. We don't agree at all. A couple of other things I wanted to say really fast, if I still have a minute.
I think the point was to do a lot of loans over 43. Which
Absolutely.
Are even
No,
yeah.
absolutely.
You have another maybe.
She doesn't even want to go to 40. So she's not.
Well, so did.
Just saying.
She's a good traditional mortgage lender.
Is she an AEI fellow?
No, but we might be able to work out a deal. I don't know.
You've got a few more seconds.
On the FHFA capital plan, look, I don't know why anybody is even entertaining the idea after 2008 that risk-based capital requirements are a good idea. They've been proven to be a horrible idea, and all they do is let people lobby for lower capital. That's what they were designed to do. That's what they did, and that's how they blew up. So even if we do come up with the right level of capital now for these things, there's no reason to think that they're going to stay there. The GSEs have a very long history of blowing through any capital requirement that Congress puts on them. That's crazy. The other thing, really fast, this whole idea about the utility and the CSP and the federal government creating something to foster competition. I'm sure there's an example somewhere of that working. I just don't know where it is.
Thanks, Norbert. Mike Stegman.
So 2 quick
2 minutes.
points. On the capital rule, under Ed's faultless compelling logic, which, I'm willing to agree with if he makes a deal with me and applies the same logic to the fact that the appointment of a new Supreme Court justice is too important to rush a confirmation before midterms. I'm willing to work for that capital rule if he's willing to work on this. On the a microcosm of the blurring the lines between primary and secondary, worldview and timing, an excellent microcosm is the duty to serve rule. Congress passed it in 2008, directs the GSEs really to do monumental work in enhancing primary market activity in 3 underserved markets. And if you really take a close look at Ed's proposed rule in 2010, the combination of his narrower worldview of the role of government and the timing where he expected Congress and the administration to end the conservatorship through legislation shortly thereafter versus Mel putting out a duty to serve rule where there is a context and expectation of an extended conservatorship, and the importance of this affordable housing requirement that Congress is directing the enterprises to engage in. It's just really a classic way of focusing in on the importance of timing, worldview, and interpretation of statutory requirements and regulatory discretion. And it just so happens that a colleague of mine, Phil Swagel, and me have a paper coming out on this in the next day or two from Milken.
Thank you. Ed, 2 minutes.
Alex, you were very gracious in granting me 2 minutes, so I'm going to yield this back so the audience can have some time to ask questions.
Okay, thank you. The audience thanks you. Ladies and gentlemen, we'll come to our question and answer period with you. Let me remind you, if I may, of what we request when the microphone comes to you. First of all, when you're called on, wait for the microphone. When you get it, tell us who you are, what your affiliation is, and then ask your question. If you feel a great inspiration or urge to make a speech, instead of asking a question, the chair will give you 45 seconds. If you haven't gotten to your question yet, I will remind you that you have to ask your question. With that, let me thank you again for all being here. And do we have questions? Way in the back, right here. You have a microphone coming right to you, right there.
Joan Trice, Clearbox. This question is for Ed DeMarco and anybody else who cares to comment. Ed, did you ever imagine that UCDP would not be used to eliminate risk, but waive appraisals by independent third-party appraisers?
Thank you, Joan.
What's UCDP?
So UCDP's Uniform Collateral Data Portal program. What's the P? Portal? The idea here was to create a standardized mechanism for collecting appraisal data. So to take the paper forms and collection of appraisals and to create a standardized electronic reporting format so that the appraisals could be prepared and submitted by appraisers into a single portal, regardless of whether the loan was being sold to Fannie or Freddie, and my hope had been regardless of where the loan went, that it created that kind of database. So I think that we created it, but when we did that, we did not change the information that was collected. We electronified, digitized the information on the form. I think the more important thing, and I've come to appreciate some of this a lot more in my since I left FHFA, is that what we really need to be doing is thinking very hard about what is the data, what's the information that we collect in an appraisal, and we're collecting the right information, and who's actually the customer for this. So if we're trying to create a competitive market in mortgage credit, that is, we're trying to create a market in which a broad array of private capital participants are willing to come and bear mortgage credit risk, a key element of that risk assessment needs to be collateral valuation. It needs to be, look, as a credit risk holder, I need to know what's the probability of default, and then I need to know something about what's my potential loss given default. And so I think we need to rethink the appraisal process in terms of how UCDP can be used to help that emerging credit market, to help those credit investors understand better what's the potential loss given default. And so we need to rethink what is the information we're collecting, but also who we're collecting it for and how we get it to them. And no, I did not anticipate the UCDP being used to create waivers.
Can I say one thing to that, Alex?
Yeah, sure. Go ahead, Mike.
So I think this gets to my point of it's not the technology, it's sort of how it's deployed, right? So the database concept is fantastic, right? So if you have, as you're looking at a property, you know that the last 2 times it sold, it had 2 bathrooms, and now the appraisal comes in and says it has 3. Somebody's wrong, or they added a bathroom. Both of those, that's really, really good information. If it's used where it's sort of a gotcha after the loan comes in of like, oh my gosh, you guys did a terrible appraisal, that's not terribly helpful. If it's used as a public information source to improve everybody's data, that's fantastic. So that's the kind of argument we have with them all the time of like, this is a great idea, how do we deploy it in a way that helps the market?
Right, that should be our question.
Thank you. I have a question over here, please.
Hi, Ann Canfield. Thanks for all of your remarks. Just a couple quick points. One on the patents, Mike. It's interesting. Fannie and Freddie both have an enormous number of patents. Fannie, in fact, has the patent for the entire origination process, and Freddie has the patent for the securitization process. They haven't exercised them. So, but it is interesting to take a look at their intellectual property. Second, the financial guarantee insurance industry is the private sector, alternative to Fannie and Freddie. And I wondered, has anybody ever taken a look at their capital requirements under Article 69 in the New York financial guarantee insurance statute up in New York? It's interesting. If you I'm sure we haven't, but it's interesting to take a look at in terms of equalizing capital requirements.
Thank you, and I'm going to take that second as your question.
Yeah.
Anybody think Ed pointed out we ought to have, for similar risks, similar capital, and here's another sector one might think of in this capital. Any comments on that?
Well, I think what Ann suggested is it needs to be part of the mix in terms of what gets examined, because it's another sort of set of entities or sources of capital that are regulated in some sense, and what's the standard by which they're done. But I think we need to look at all these different standards. And look, I mean, this isn't all about, is the GSE level too low? Sometimes the question ought to be, are the other requirements excessive? Are they punitive? I mean, when I went all the way up to 4x in my little, presentation, I wasn't joking, right? The capital requirements can be that different. So maybe they're both wrong, but, that's not necessarily good for capital flows and capital allocation in our economy. If we're off by that much, I think the regulators really ought to be getting together and thinking, more consistently about that. And what the rule that Ian just talked about needs to be part of the mix.
That seems to me a very strong point, Ed, and all of us who worked on this know that in the past, one of the great causes of the inflation of Fannie and Freddie was the differential capital requirements between the same loan on some banks' books as on their books, and the whole system got hyper leveraged in part because of these different capital requirements. Other questions? Yes, right here, please.
Frank Vetrano. A lot of discussion today about the expansion of the DTIs and expansion of the footprint of the GSEs. To the extent that it's actually coming from FHA and essentially it's market share being shifted from one government agency to the other, should we as citizens care where that risk is going?
Anybody want to take that one?
I'll take a first shot at it. So that one chart that I went through quickly, the problem is DTIs with one exception. So there are 5 government agencies. 4 of them have been moving out on the DTIs simultaneously, of course led by FHA, but Fannie has been no slouch, particularly the last year or so, and Freddie, the VA. As I mentioned, they've been going out on cash-out refis, which is completely crazy. There's one agency that actually took what the Bureau said when they issued the patch seriously, and that is rural housing. And they said that we should be getting back to 43% as the limit, and that's the goal, and we shouldn't be sort of just using this as a way to gin up higher DTIs. And so they actually implemented a QM patch rule that was different than the others. They limited and they actually restricted their percentage above 43 has gone from 20% to 10. And so it's this percentage of the total market is much higher above 43 than it was 5 years ago. And we document that every month in our National Mortgage Risk Index. So it's it's an arms race. Everybody's moving out with one exception. Interestingly, the house prices for the rural housing have been basically going up with inflation since the last 5 years. And more on that to follow from our new research.
Ed, thank you. I think we've said DTI probably 40 times today. And everybody here, of course, knows what it is, but we may have people on the live streaming and the general public who don't. So take a couple seconds and say what a DTI is.
So it's a total debt-to-income ratio, which your numerator is your monthly housing debts, including your monthly debts, including your housing debts, principal, interest, taxes, and insurance, plus your other debts, credit cards, other loans that you might have that are unsecured, student debt, various other expenses monthly, but not things like utilities and things like that. Car payments are included, but not utilities and other things. Your denominator is your income, pre-tax. And so numerator are your monthly obligations, and your denominator is your income pre-tax. That's your total debt-to-income ratio.
Thank you.
Alex, ma'am.
And it was 2836 up until the late 80s, early 90s, and we're now where about almost half of the loans are above 43.
Ed, you had another point.
Since we have been, several of my colleagues have been talking about the DTI issues, to put a footprint and maybe in some sense, Frank, to get at a portion of your question about risk, and should we care, point out that recently the Fannie Mae had altered its underwriting to allow for greater high DTI, low credit score, low down payment lending. And so the importance of having private capital at risk that is monitoring and responding to this was manifested because the mortgage insurance companies, stood up and said, wait a minute, we're not, this is not prudent, we're not taking this risk. And so there was a bit of a pullback there. But it goes to, real private capital, real skin in the game at risk is going to pay attention to these things and manage it. And, we should believe a bit in markets.
I would just add to that, we've also looked at the private sector's non-Fannie, non-Freddie, non-agency use of DTIs, and the DTIs have not budged in the 5 years. So the private sector, own money at risk, has basically kept DTIs at the same level. It's only the agencies, save the USDA, that have been increasing them.
Mike, you had a point.
Yeah, certainly in a reform system where there is a government guarantee on the GSE side with a lot of private capital, you should not get into a price war over just shifting kind of market share. And while they're in conservatorship, which I think is going to be for some years to come, there ought to be better coordination and communication. We shouldn't see this rapid movement back and forth where a reduction in FHA moves it all there, and then you bolster and you push for the GSEs to do more. It just is not healthy, and there ought to be, and GAO has said it, a number of studies have said there needs to be coordination. And in a future system, it shouldn't matter to a consumer where the credit enhancement comes from. It should be based really right on the characteristics of the loan, the mission of the organization, but there ought to be coordination.
Okay.
Maybe just one last thing
Go
to
ahead.
add, and Frank, you know this better than anyone, right? That, the GSEs do risk-based price considerably with their LLPA grid right now. FHA is flat price, so if the GSEs take away the better credits from FHA, that's adverse selection to that ultimately harms the taxpayer. So you got to worry about that, as you did.
Another question. Anyone? Yes.
I thought I'd go back to the capital.
Will you tell us
I'm
who you
sorry.
are, Jeb?
Jeb Mason from Cypress Group. I thought it would be interesting to go back to the capital rule a little bit that FHFA recently put out. And it seems like one of the things that the policy community is struggling with is sort of thinking about the enterprises while they remain a duopoly in conservatorship with all these special privileges conferred upon them with lacking a credible resolution regime, and clearly they couldn't be allowed to fail. And trying to contemplate a world in which you have a competitive market of some sort, whether it's guarantors and one framework that people have proposed or other credit enhancers of some sort that are truly private, competitive market, much smaller market shares presumably relative to one another, and able to fail. And thus you have real market discipline. And so I guess I don't really have a statement about that or a pointed question, except that one of the failings, it seemed like, of the FHFA proposal is that it doesn't make a clear distinction that I see between those two worlds, and it seems like it ought to, and that's going to have implications for things like what you might do on credit risk transfer and other things to get from point A to point B. Care to react to that? Maybe
There you got to your question. There you go.
Yes, I mean I agree, Jeb. I think that if the vision of notwithstanding Mike's probably his the notion that these conservatorships could go on for a while, if the objective is to gradually build a true market for mortgage credit risk, so that we get out of the systemic risk that was so embedded in the Fannie Freddie model. Maybe I'm assuming too much about knowledge about that, right? Pre-conservatorship, $5 trillion of mortgages being securitized through Fannie and Freddie. Most of the interest rate risk with that went to the investors in the MBS, except for the MBS Fannie and Freddie bought back for themselves. But all the credit risk, save for what was insured by mortgage insurance companies on low down payment mortgages, all of that credit risk was on the balance sheets of two companies, Fannie and Freddie. So the whole market for mortgage credit risk was two companies, right? And that failed. I mean, if they just make mistakes, even with good intentions, that fails. And so when you layer onto that the complete disjointed capital regime, where the capital of Fannie and Freddie was 45 basis points for mortgage credit risk, and for a bank it was 4%. All that risk, as Tom Stanton started saying in the 1980s, risk is going to go to where the capital requirements are the lowest. So I think, Jeb, if we do want to envision, wherever it is down the road, a post-conservatorship world in which we create some kind of a competitive private capital market for most mortgage credit risk, then thinking about this capital proposal is an important element in how we start building steps to that kind of outcome. We got to start working now on leveling the playing field.
So there was an event last night at Urban that Jeb was there, and many in the audience were there, and the person from Arch had some comments about the pro-cyclical nature of the capital proposal, because there's a big haircut that's given as house prices go up and the loans are seasoned. Then the capital requirement starts going down pretty rapidly. The faster house prices go up, the faster it goes down, until it bumps into the leverage requirement, at which case you're overcapitalized relative to your risk. And so now you need to increase your risk. And so you've got this very pro-cyclical process going on, and your capital is thinning out as you're in this boom that eventually has to revert. And so that's the kind of problem that these rules tend to always end up with, particularly when you concentrate them in two very, very large organizations like Fannie and Freddie.
Almost at the end. Any other comment from the panel?
Really quickly, banks didn't have a federal capital requirement until the 1980s. Call me crazy. Maybe that's what screwed this up. Maybe we don't need to level the playing field with capital requirements.
A good provocative comment on our end. Ladies and gentlemen, thank you so much for being with us, and let's show our appreciation for a great panel. Before the conservatorship is ended, we'll have another conference on this.